Well, we have some volatility in the markets, and stocks are still maintaining their gains. It's a really tight consolidation, but they're edging higher as the end of the year approaches. So we're going to talk about what is happening in the markets with Jim Welsh from Macro Tides. We're going to bring him in. Hey Jim, how are you? Good to see you.
Good to see you, Blake.
Hey,
Always fun to join you.
things are kind of crazy, but we have a lot happening just before next week, as we have the FOMC coming and making a decision on interest rates, which the markets are, generally speaking, they expect the Fed to cut here. But how close of a call do you think it's going to be, and how do you think the market's going to respond to everything?
I think it's going to be a close call. I think the Fed will cut rates. There are 12 actual voters. So you could get seven voters in favor and five dissents, and you're still going to get your rate cut. So I think for all the reasons we've discussed and I've written about over the last couple of months, it's going to be a close call. You have two camps, those who are worried about employment and not wanting the economy to slow too much and cause unemployment to go up. And you've got those who are concerned about inflation. Inflation is running close to 3%, well above the 2% target. And they think, hey, we've already cut rates 50 basis points. And so we're closer to neutral. Let's wait and see how things play out. So those divisions aren't going to go away. And maybe the most telling thing and the thing to really focus on is the summary of economic projections, the SEP. Every 3 months, the Fed updates these. So that's the dot plot, how many people are and where are they in terms of expectations for rate cuts. And given that this is December, that'll be closely watched. And again, I think we're going to see divisions just as we saw in September, where there's going to be some people who want to be more aggressive, and then there's going to be people who are going to really just want to wait and see. I think, there's some people in September, Blake, who penciled in three cuts. So they're going to probably, some of those are going to vote for the cut next week. But I think even some of those people might be, all right, I wanted, and I thought it was appropriate to cut three times, but now I'm on the fence. And so again, the dot plots is going to reveal to us, and we'll talk about it next week. Uh, you know, was there more of a shift toward pulling back on rate cuts? I think there's a good chance that's going to be the case. I think you could get four dissents, Mirren wanting 50 basis cut, and then three other voters saying they weren't in favor of this cut. So it's
Yeah.
going to be pretty divisive, but I think at the end of the day, the cut will happen.
So the cut's going to happen. It's going to be divisive. It's going to be close, but we're still not getting the data that the Fed probably needs to make a decision. I guess the question I need to ask you before we start looking at all the
Yeah.
slides that you brought is, will the Fed be? Everybody's expecting a hawkish cut, meaning we're going to get a cut. The Fed's going to say in order to cut more, we're going to need to see data, but they still need to leave the door open. So I guess the question is, will
Hmm.
it be hawkish enough to turn the market lower? Because they have to be somewhat neutral to open up for the data that's coming. And the stock market will probably like that and really like it if the data, if the jobs data tapers off the following week.
Yeah. I think the dot plot is going to probably be more hawkish than dovish. But when I went through the September dot plot, what it showed really, if you weighted every dot, it showed two cuts, which underscored the divisiveness. I think something similar, Blake, is going to happen again. And the conjecture is going to be, well, I think they're going to cut, but they may not cut until March. Or, some people are talking about, well, they're going to announce in January a resumption of QE, that they're going to start buying Treasury bonds. So there's a lot of moving parts. I think that people on balance, seasonality is positive. The narrative that the economy's okay. Um, I just think that if it's a hawkish cut, you might get a small pullback in the market, but I'm not sure that will be justification for, anything more than a 3% pullback. I think is very unlikely because the economy's still okay and people will still think, you know what, we're going to get at least one or more cut, as we get into next year. And I think that'll be sufficient for people to remain, positive.
All right. One of the last things I'm gonna ask you before we get into your slides is just your thoughts on President Trump floating
Kevin
Kevin
Hassett.
Hassett's name. He did it
Yeah.
on accident, quote unquote accident. Uh, but regardless, he's getting some pushback. We hear
Yeah.
now from Wall Street's like, look, he doesn't have the support of the Fed. It's going to be a cluster bomb. I used bomb instead of
Yeah.
anything else.
Right. I
This
understand.
has been a cluster mess, and the Fed, and we're going to lose credibility. If he ends up cutting rates, we could be in a situation like we were at in 2024, where actually the 10-year yields went up as the Fed was
Yeah.
cutting. So,
Yeah.
this type of feedback that Trump is probably getting himself, how likely is it to alter his pick? And do you think he's even paying attention, or do you think he's taking this into account, or do you think Hassett's not even going to be the man?
Yeah. Well, first of all, I haven't heard anybody say that Hassett wasn't qualified. To me, it seems to be a rather important point. Now, in this day and age, there's so much politicalization of almost everything. And now, so if you don't like Trump, you're going to criticize no matter who he nominates. And I do think, Blake, there's some of that going on. I haven't seen anybody say he wasn't qualified, given his background and everything else. Well, that's really where the conversation should remain. Now, how much of an influence does Trump expect to have on him? And then how much influence can Hassett have on the other 11 voters? And I think, again, people don't fully understand the way I think the Fed operates. Those people vote, and I think they vote genuinely based on what they think is appropriate. And so this idea that it's almost like a rubber stamp and oh my God, I just don't buy that. I really don't. So as long as the consensus is he's qualified, as opposed to like G. William Miller back in the mid 70s, who followed Arthur Burns, a guy who truly wasn't qualified. Um, I think that's where we have to focus on. And, the expectation that as soon as the new guy takes over in May, oh man, the Fed will be cutting rates. I just think that's stupid.
But
I really
Jim,
do.
isn't it possible though, even if, like, let's say the vote is split, or maybe with his vote it would be he still has to the vote would be to keep rates unchanged. Couldn't he still say, you know what, I'm still going to cut rates? I mean, I know I don't have the whole support of.
Unless he has six other people, it don't happen.
Okay, so
That's
he
the
can't.
numbers.
Okay.
You got seven. It's not like his vote counts for three. He's got one vote. People like Waller and Bowman, who are in the rate cut camp right now, I think even Waller's made some comments. Okay, we're getting the funds rate down closer to neutral. And at some point in time, we're close enough to neutral that we really should stand back and wait. So I think people are not understanding the process and the thinking that goes behind each of these people in terms of coming up with, am I going to cut rates or I'm not? And to assume that one guy is going to ride in. I mean, Volcker was one of the strongest chairmen ever. He had all kinds of dissents, and yet the Fed did follow his path, and because he was able to get enough people, convince them that, in his case, hiking and keeping rates high for a period. I mean, again, people forget the funds rate is 20% in 1981. 20%. So again, I just think that people are oversimplifying this. They want to be bullish. Oh, I want gold to go up. So Hassett is going to be a pal of gold. All right. you're welcome to think that. I'm not sure that really will, happen in the real world unless it's justified. So I don't know, call me naive. I actually think, although I criticize the Fed a lot for a lot of, bad calls and everything else, I think they're genuine in terms of wanting to try to do the best they can. And so a lot of this conversation to me is kind of like, well, they're just a bunch of puppets. And, seriously, that's what you think? That's your analysis of the Fed? Good luck with that.
All right, Jim. Well, with that being said, let's jump into some of your charts that you
Okay.
brought. And let's
Yeah.
start with the San Francisco Fed. And what are we seeing here as far as this chart goes?
Yeah. Well, this is pretty interesting. And I think this is one of the reasons why I think the Fed will cut. Is a few weeks ago, the San Francisco Fed came out with this research report. They went back to 1870. And this shows the effective tariff rate in the United States. And you can see off on the left half, man, tariffs were much, much higher. And you can see some of the big swings. So you can kind of divide this chart into two halves, the left half and the right half. But what the San Francisco Fed found was you had a greater impact on the economy, inflation, and unemployment when you had big swings and tariffs were high. And in those instances, tariffs had a negative impact on GDP growth. Um, uh, Unemployment went up, and interestingly enough, inflation went down, which is really counterintuitive. Um, what makes this valid research from my perspective, Blake, is on the right-hand side, you can see starting in, 1950s, you can see the tariff rates were above 10%. By 2018, they were under or close to 3%. And there weren't many squiggles. But what the San Francisco Fed found was when there were squiggles, they also had an impact on unemployment, GDP, and inflation. And the thrust of this piece is, well, look at what's happened over the last year with tariffs. Well, it looks a lot more like what happened on the left half of the chart in terms of the magnitude of the increase in tariffs. So my takeaway from reading this was, all right, we're likely to see GDP negatively impacted. Why? Because trade starts to get constricted like it did in the 1930s. World trade, global trade dropped by 65% after we did Smoot-Hawley, everybody else raised tariffs, and that was the outcome. GDP hurt. Well, tariffs create uncertainty. And net result is you wind up getting less GDP because businesses pull back. They're less inclined to spend aggressively. And then the unemployment rate, well, you get a slower economy, you're going to get higher unemployment. The tariff thing on inflation was interesting because I think initially tariffs do cause some price increases. But as prices increase, you're zapping purchasing power for consumers. And what that means then is they wind up are able to spend less on a broader list of categories in the economy. And the net result is as you kind of hit demand, ultimately that causes prices to decline. So in a sense, disinflation as opposed to maybe deflation, I think there's a real risk we're going to see deflation, but other things are going to be contributory to that. But I just thought this was very interesting. And so to the extent that some of these Fed governors look at this research, is it going to make them less or more inclined? Maybe there is a reason to cut rates. So that's one piece.
All right. Well, I mean, I don't understand how it translates to deflation, but that it's going to be interesting to watch. But your next chart is
If you
on,
get slower economic growth, like that's really where you get it. You
yeah.
get slower economic growth, and that means more unemployment. That means less demand, and then prices come down.
So that's good for the
So it
economy.
doesn't happen overnight.
That's
So
good for the economy.
Not really.
Okay. All right.
Let's go raise those stairs. Okay. So obviously we talked about it earlier. People are worried about inflation, and then you've got people worried about the labor market. On the left side, we see the 5-year break-even rate. Powell has referenced this during the course of his press conferences. And what you can see is off on the right-hand side, we're seeing the 5-year inflation break-even rate has been falling. Well, if you're worried about inflation, well, okay, this is constructive. If you're worried about the labor market and unemployment, this shows the labor differentials, how many people are saying jobs are hard to get versus plentiful and easy to get. And what we've seen, obviously, since 2022 is a huge unwind, where jobs, were plentiful. And now all of a sudden we're seeing fewer and fewer people saying jobs are plentiful. And the blue line is the unemployment rate. And you can see is when there's noticeable movement in, the plentiful or not plentiful jobs are the labor differential. As it declines, that's good for unemployment rate coming down. When it creeps up, it says that we're likely to see the unemployment rate tick higher. So again, to me, this increases the probability that we will see a rate cut, irrespective of the divisions. These two charts aren't going to make people, oh, I don't have to worry about the labor market if we cut 25 basis points. And people, oh, I'm not worried about inflation anymore, because the break evens have fallen a little bit. This is just stuff on the margin.
Yeah.
And anyway, that's my conclusion.
Okay. All right. Well, Jim, the next chart you have is on ADP. We had a jobs loss. And
Yeah.
and tell us a little bit about how you read that.
Okay. The reason, well, it's not a plus, but more importantly, small businesses in this country create more than 50% of all jobs. So if I'm worried about the labor market and I see that, gee, 120,000 jobs are lost. Now, again, did the government shutdown play a role here? If you're exposed to government spending and you're not getting the money, you're kind of almost forced to lay off some people. So I think I don't want to overreact to this number because of that. If we didn't have a shutdown, this number would be, I think, more worrisome, definitely. But we'll see what the next month shows. Clearly, job growth is slowing. We've talked about it in the sense that, how many jobs do we need to create so that anybody who's joining the labor force has a good chance of getting a job? And that has gone from 200,000 to 100,000. The best guess now is 30 to 50,000. So again, it's important to keep the perspective of how many jobs do we really need to create. And then that kind of gives you a yardstick. Well, how much is this shortfall? But the fact that we saw this much weakness by small businesses, I think, again, if you're worried about the labor market, even if you're worried about inflation, somebody might be a little bit on the fence enough to say, you know what, I can go along with one more cut. I thought only two was going to be appropriate, but so again, these are all reasons why the next chart, I think, is a reflection, which is the odds of the Fed cutting rates, and it's up to about 86%, I think, as of yesterday. They might even be a little higher today. Now, what's interesting is the unemployment claims came out. They're below 200,000. So,
Yeah.
which is
I
a
mean,
really
now,
low
now
number.
that would probably where it was a reflection of the holiday week, right?
Yeah, yeah. They kind of get, no matter how they try to seasonally adjust it, they get screwed up. But my point being is, even the last month, they've been hovering around 220. Above 250 would be worrisome. Well, we're going sideways, and we got this data point which says, okay, more the reason. So it's really the data is mixed here. But on balance, I think the Fed, at the end of the day, there's enough people on the Fed that will vote to lower the funds rate. As I said, you only need 7 out of the 12 voters. So I think they'll have those 7 voters, and there's going to be dissents. The dot plot is going to be the key thing I'm looking at, Blake, because that'll give us a better idea relative to September. Some of the people that were in favor of three cuts
Yeah.
in September, well, have they moved more to, well, I'm only in favor of one cut or two cuts in all of next year. That's what we'll find out.
All right. Well, let's see how you feel all of this is going to play into the Treasury market because, I
Yeah.
mean, we've seen yields globally rally. Now
Yep.
they've backed off the last couple of days,
Right.
but I mean, tell us how you feel here.
Yeah. Well, we've talked about that off and on. We talked about it last week, in terms of, what's happening with yields is global and in part because of supply. And obviously, the Bank of Japan has been trying to reset monetary policy after 25 years, 30 years of extraordinary accommodation. Their inflation rate is north of 2% and the policy rate's at 50 basis points. So the real rate is negative. So they indicated, yeah, we're leaning toward, hiking again at the next meeting. So I think it's, as supply increases, every country is going to be issuing more bonds. It's, how do you attract buyers? Yields go higher. This is the 10-year, and you noted earlier, and we've talked about this on many occasions in terms of, hey, the Fed's cut rates and Treasury yields are going up. Folks, this doesn't, I mean, for the Fed to have cut 150 basis points since September of last year, at that point in time, the 10-year was at 360. So it's at 410. And you've
Right.
cut the short rates by 150. It's kind of like, okay, something else is kind of going on. Part of it is, hey, the economy's been holding up. It's not like rates are going up because you have and the economy's noticeably slowing. But I think that tells us something about we're kind of in a new era. I think we're in a secular bear market for treasury yields over the next 20 years or longer.
Really?
And, oh yeah, yeah. No, I again,
In
the
yields?
decline in
In
higher yields, lower bond prices,
Okay,
and I'm
okay.
basing that in part. If you look at a chart of TLT or the 30-year bond, going back to the last, 15 years, or actually you got to go back further, but you'll really see one, two, three, four, five. I mean, TLT went from 179 in March of 2020 to 82 and change last year, but it did it in five waves. So from my perspective, Blake, that indicates the trend has changed and a new secular bear market has begun. In the last time it was like 36 to 39 years. Secular bear market from 45 to 81, secular bear from or bull market from 81 to 2020. So that's my bigger picture. I think the 10-year has the potential of getting to 7.5%. And you say, oh my God, that seems impossible.
I'm sorry, I'm just pulling
Well,
up a chart here. So,
yeah, you can look at this. You can see one, two, three, four, five. All right. So the bond market's been, we had this gigantic decline.
yeah,
And so far the rebound after that has been pretty darn feeble.
right.
So again, it's like, all right, is there a chance you could get another leg up? Yep. I just think that potentially we're going to see another leg down first
Mm,
before a larger rally takes hold. And that what it implies near term for the 10-year is getting back to 5% or a little bit above. And once it does that, I think the economy is going to slow noticeably, and then we'll have a more pronounced rally in the 10-year yield and treasury bonds in total. So the trend lines are the red horizontal line is at 420. The green declining line is obviously tagging all the recent highs going back for, I don't know, at least 6, 7 months. And then what we see at an inverse head and shoulder, where the neckline is at 420, and this is classic chart stuff. So if you take out 420, the basic measurement is, well, what was the neckline? In this case, we'll call it 420, and the head was 395, call it just to make it simple, 25 basis points. You add that to 420, and you get 445. So that to me is the key part here. What will cause treasury yields to get above 420? And if and when they do, a run up to the 440, 445 will probably follow pretty quickly.
All right, Jim. Well, the next chart you brought the dollar. Now, you and I have been having a little bit of a talk about the dollar. What do you make of
Yeah.
this?
Well, what's interesting is, I think the Fed is going to cut. I don't think the dollar is showing a lot of weakness. When we've talked the last 2 weeks, my take was I think we're going to see a pullback to the 50% retracement of the rally we saw from 96.21 to 139, and that targeted 98.30. There was a little spike low at 98.03. And so my take, and I also mentioned last week, if you look at the RSI, when the dollar got up to that 139, the RSI made a lower high. And that all of that suggested we're at resistance. You got an RSI divergence, time for a pullback. Well, how deep? And the guess was 98.30, maybe 98.03. I think that once this pullback is over, my guess is the dollar is going to punch through that resistance up around 100.
Okay, so you're basically looking to really, really buy this pullback that you see in the dollar, if we see it.
Yeah.
Okay.
Yeah. And getting below 97 would be to me like, okay, time to reassess, you know.
Yeah. All right. All right. Well, then the next chart you have is gold, and gold's been steady. I mean, it's
Yeah.
tried to break out. It's been holding the breakout area, I guess.
Yeah. 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 Yeah.
But
I,
unlike silver, where silver's just ripping, gold
right.
has not.
Yeah. So you get an intermarket divergence. Silver's making new highs, gold isn't. All right. So that's a tell, if you will, when everything's going in the right direction and they're doing it together. That's more positive than one going up and the other not confirming it. I didn't think we'd get above 42, 44, so I was wrong. It doesn't change the bigger picture in the sense that my view has been is that 43.81 was the end of wave three from the low in 2015, and that we were about to go into a wave four. My initial thought was that decline to 38.87, the rebound to 42.44 was setting us up for a drop to at least 37.50 and potentially down towards 33 and a quarter, which was the 382 retracement of the rally from 16.16 to 43.81. Getting above 42.44 kind of changes it, Blake, in the sense that it opens the door that we're going to get another choppy sideways period that's going to last months. And if you look at off to the left-hand side, when gold peaked at 34.96, you had a little ABC down for an A, choppy up for B, pull back for C, D, E. And at that point in time is when I said, I think we're about to break out above and go to a new high. And that once we got above 34.03, that was the signal. Now, I didn't expect 43.81, but I thought that that pattern implied a breakout, and the width of the pattern and so forth suggested 3750, maybe up to 3800, which is that green line.
Yeah.
So it ran further than expected. That all said, I still think we're in wave four. It's going to take time. And if this triangle pattern is right, at a minimum, gold can be expected to drop below 4,025. Now, the decline to 3750, 3325 hasn't been eliminated. It's just been the probabilities have lessened. And right now it's like, okay, given what we're seeing, I think a pullback under 4,025 is likely. And that, from a trading standpoint, if the triangle's right, well, you get below 4,025, you shouldn't take out 3887. So you've got a very known stop. That then would lead to another rally uh, under 4,025, call it 3980, just for fun. Well, you should rally, but not take out 4264. So there's a potential, for what, 6% rally?
Yeah.
Well, that's not too bad. So anyway, the higher high at 42.63 reduces the odds of a pullback as far as 33.25, but it doesn't change the outlook that we're going to be in a corrective mode. You can either correct in price by declining 382 or 50% of something, or you chop around sideways. And again, my take is that that was wave three. This is wave four. Once wave four is over, we're going to go and make a higher high.
Okay.
So
All
now
right.
it's just a question of dealing with these squiggles. And just like what happened, once the triangle was really fully formed, it's always easy to kind of say, okay, we're ready to go now. And it worked, it served well back a few months ago, in August, when gold traded above 3,400. It's like, all right, it's on its way now.
Okay. All
So
right. The next chart is Bitcoin. Uh, what do you make of this? It's been kind of choppy
yeah,
waters.
yeah, yeah. Well, again, what I laid out is I think there's a decent chance Bitcoin's going to find its way down to that 74,496. You can also see two other lows, 78 and change, 76 and change, to the left of that low.
Oh, oh yeah.
So that just shows, okay, that's where you could start to come into some support between 35, 75,000 and call it around 78,000. The pattern to me looks like you had one down, two up, then one, two, three, the bounce, interestingly enough, stalled underneath that green trend line, which goes all the way back to January of 2024. That looks like wave four of three. So my expectation is you're going to see a drop that undercuts 80,742. That will complete wave three. And then you're likely to see another rally back up towards that 94,000 number for wave four, and then another drop that gets under whatever that low would turn out to be and get closer to the 75 to 77,000 range.
Okay.
And then once that is all done, then Bitcoin would be ready to make another pretty big move.
All right. Well, we'll
But
see. We'll see if that takes place. And the last
yeah,
chart, Jim, is S&P. It's just been grinding higher.
yeah,
Doesn't look like that wants to change at all.
yeah, yeah. I mean, again, as I said last week, getting above that green trend line increased the probabilities we're going to new high. I thought we were going to rally up towards that. Getting above it was going to be, all right, where do we go next? The only question mark I have, Blake, is are we going to see a modest pullback before the S&P marches to a new high? If you look at the SMH, the semiconductor index, it's very constructive. The Russell 2000 looks like it wants to go to a higher high. So it's just near term, it just looks like, oh, a pullback. That top panel is a moving average of ticks, and it just shows how many stocks are going up versus down, literally every few seconds. But this is smoothed out over a period of time. And you can see we're making higher highs, but so far the ticks aren't where they were a couple days, 3 days ago when we got to 68.50 again. So, and you had a little one, two, three, four. There was a triangle after we hit 68.50. This chart is, you need a smaller time frame to show A, B, C, D, E, and we've gotten this push. So again, there's the potential for a pullback. I had that blue horizontal trend line because of some prior lows and highs. Okay, 67.60 to 67.70. But my bias here is that if we do get a pullback, I think that's going to lead to a subsequent rally that takes the S&P above 69.20.
So basically we are looking at 7,000 then.
I would think, you know, I mean, uh, yeah, I mean, again, Nvidia to me looks like it can rally 192, 196. Well, that's kind of important. The semiconductor index looks pretty constructive. It hasn't really started to roll over whatsoever
Yeah.
from this recent rally. And the Russell is getting a bid based on the expectations that we're going to get a rate cut. So we'll see if the market interprets next week's cut and the dot plot a little less bullishly. Well, maybe that causes us to have that pullback. You know,
Well, we'll see, Jim, if we do get a pullback. Next week's going to be a really interesting week with the FOMC. Guys and gals, I want to thank Jim for spending time with us. If you do appreciate what Jim does, make sure you give him a thumbs up. Subscribe to the channel down below. Comment down below if there's something that you want to see. And Jim, what's the best way for traders to find your work?
Macroties.com. If you go there, you'll be able to read a number of recent weekly technical reviews. And the November Macroties, which did a deep dive on artificial intelligence and the outlook and all the rest of that. Or send me an email, jimwelshmacro@gmail. I'll send you a recent report.
All right. Well, Jim, thank you so much for spending your time with us. And I appreciate you. And I can't wait to talk to you after the FOMC and see what happens.
Hey, it'll be really, really interesting. I love that kind of stuff, so yeah, I'll try to be prepared.
All right. You always are.
All right.
Thank you, Jim. Have a great one.
Have a good week.
You too. Bye-bye. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.